One of the big long-term trends in Canada is the growing demand for homes. We often look at that story through the lens of housing itself, but in the stock market, there are a number of real estate plays tied to the residential market. Minto Apartment REIT is one of them. The business operates more than 24 notable rental properties across Canada's biggest cities. Its roots tie back to one of the country's biggest real estate players, Minto Group. Minto REIT went public roughly 6 years ago. Jonathan Lee is the president and CEO, and he joins us here in studio. Nice to see you.
Hi, John. Thanks for having me.
Good to have you with us, and obviously a big topic that we're constantly talking about, the demand for housing. In terms of your business, though, how's it structured? How does it operate?
So we own 27 properties in major cities in Canada, comprising about 7,700 units. We are only in the major cities, so we're in Toronto, Ottawa, Montreal, Calgary. We are also building with our partner Minto Group properties in both Vancouver and Victoria. What sets us apart from some of our competitors or differentiates us is the fact that we are only in the major cities, we are urban focused, and we're newer. And we like being urban focused because it helps us protect land value, land costs, and replacement costs. And we like being newer because it minimizes the amount of capital expenditures that we need to invest in our buildings going forward.
And I think when investors talk about investing in REITs and ones that are tied to residential properties, they constantly come back to this long-term story of housing demand. What do you see in your business? Can you just give us a little bit more on sort of how things have played out, what the roadmap looks like just based on demand?
We're really excited to own rental apartments in Canada. About a third of Canadians rent, and that percentage is growing month by month for the following reasons, right? We have housing unaffordability, so it's cheaper to rent than it is to own a home. We have a lack of housing supply in our country and a very inelastic housing supply. We can't build fast enough. Our own federal housing agency, CMHC, says we need to build another 3.5 million homes by 2030 in order for us to solve this, affordability crisis. To put that into perspective, we build about 225,000 homes a year as a country, and we're running at basically max capacity because we have a trade shortage as well. So our ability to build quick enough is not robust, but we do have a robust immigration policy. And when you put all those three things together, we're pretty constructive for the rental housing business in Canada.
Now, you talked a little bit about your desire to be in some of the most urban areas and some of the cost benefits that can come from that. And when it comes to your own balance sheet, you guys have made some moves as well. You have divested some properties. It seemed like most of that was quite simply to deal with things like debt. Walk us through how you think about what properties you want to own when it comes to actually the metrics on the books.
Sure. So we've been extremely focused on converting our net operating income, which is basically revenue minus expenses, down into cash flow per unit. Because in a market like this, we feel that is a really important thing to focus on. And how we've been doing that is effectively managing our capital structure and managing our capital allocation. And so some of the things that we've done is we, at one point at the peak, had about $260 million worth of variable rate debt in our debt stack. And that money costs 7%. And alternatively, we can get CMHC long-term mortgages, and that costs us about 4.5%. So we were really focused on reducing that variable rate debt. And what we did was between upward refinancings and asset sales, from its peak of 26% of our debt stack, we reduced it down to about 6% of our debt stack in our last quarter. And we're actively working on other refinancings to hopefully get that pretty close to zero. And the outcome of that, it's very accretive to us in our cash flow per unit. And there's a chart that I think we're going to put on the screen that effectively shows over the last 6 quarters, we went from minus 10% growth and grew it all the way up to 27% growth year over year FFO per unit. And that's really what we're focused on, and we're very pleased with the results.
Well, I think, and there are a number of, on Bay Street, there's a fairly favorable view of your business, and I guess metrics like this would factor into that. I think one of the complicating factors in the short term, maybe for investors, is just the story on interest rates. Like we talk about every day about our interest rates going to stay where they are, they're going to go down, and it seems like all sorts of asset classes, including fixed income, sort of will bounce around just based on that. For your business, how are you thinking about where interest rates are a year from now, 2 years from now? How are you approaching all of that?
It's impacting every single minute of every single day of our job. And we can really only control the things that we can control.
Yeah.
Things like balance sheet, things like our operations, things like capital allocation, things like cost containment. So our heads are down, focused on that, and I think that has resulted in some of the cash flow growth that we've been enjoying. But the reality is there's a massive dislocation between the public markets and the private markets, and we think that's an opportunity. At the end of the day, we own some of the highest quality real estate in the country. I think many of your viewers are from Toronto, many know Toronto. To give you some specifics, we own the big white building with the Minto sign on it that you can see from the Gardner at King and Bathurst with the Farm Boy and the Dollarama at the bottom. We own 61 Yorkville, which is a kitty corner from Four Seasons in Yorkville. And then we own a beautiful newly renovated building called The Row, just northeast of Yonge and Eglinton. These are trophy assets, irreplaceable assets that, because of the dislocation I talked about, you can actually buy for a 25% discount to our book value. So we're really just focused on what we can focus on. As interest rates go up, we go down. And as interest rates go down, we go up. We are not immune to that. And that is that's what's driving a lot of our stock price performance. But we're really excited about what we own and where we're going.
A very residential focused, even though you mentioned the retail, like there might be retail storefronts at the base of some of those properties, but it's very much a story on the residential market. Real quickly before I go, since you're in so many urban centers, and I think most people will say most of our biggest cities are likely just going to get bigger over time, what else can we be doing to make our urban centers really shine? Things like infrastructure. What are you guys thinking about? What plays into that? What's top of mind to making your business and your building successful, but also those communities successful?
The Minto Group that you mentioned at the outset is a 60-year-old company that has been very focused on reputation, transparency, honesty, but also building high-quality communities that are great places to live. And at the end of the day, that's what we're trying to do. We're trying to operate beautiful, well-amenitied buildings in great locations that will stand the test of time, and that's really what we're focused on.